This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on, speaking of volatility, to a very interesting subject for this week's Postgame chart deck. What's next for the summer? And of course, we'll also include my extended crude oil coverage. Listeners, you'll find the download link for the chart deck in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, look for the red button above Harley's picture that says looking for the downloads. Patrick, what's next for the summer?
Well, I wanted to hit the S&P 500 first, and what we clearly have is now a breakout of the trend line and closing prices above the 50-day moving average, which are some of the first signs of that the bulls are at least mustering up something from an incredibly oversold condition. But I wanted to just put the S&P into a little bit of context. I mean, we've been selling for 6 months straight. I mean, yeah, there was a bit of a rally in March, but overall, it's been a pretty predominant downtrend that has been ongoing for 6 months. And inevitably, like if you look back at previous bear markets, even let's say using the analog of 2008, while the whole bear market was 18 months, there were multiple bear market rallies that occurred during that period. So after 6 months of selling, seeing a counter trend rally is not out of character. So now that these trend lines are broken, what I'll be watching to see is if we can get the S&P closing north of 4,000. At that moment, that may usher in a short-term summer rally that during the month of August could see 4,200 on the upside and a quiet grind that makes the next kind of sell window going into the September and into the fourth quarter. And so really, if at this moment the S&P follows through here and we start closing about 4,000, it may just mean that the summer is just going to be a quiet grind and the real moves are coming later this year.
Well, that certainly makes sense, and I think it's consistent with some other major bear markets that we've seen. I don't have the chart in front of me, but just off the top of my head, and forgive me if I get this wrong, folks, because it's more than a decade that I'm going on my memory now. I think the 2008 event, we had a pretty good summer rally that tricked a lot of people into thinking, okay, the bottom's in. And then the really ugly move didn't come until, September, October, when it really got nasty and we got new lows and then the bottom fell out of the market. So I guess the question is, it looks like you're targeting around 4,000. I'm assuming that you chose that number because it would be equivalent to the late May peak, the last significant peak that we saw that tested that trend line. Is that what you watch for? And, if we go above that, does it change the outlook to say this really was the bottom? Or how do you think you would know when the next move down has begun? Because it seems like we just broke a trend line. There ought to be a bit more upside before this rally is over, at least in terms of reading the technicals, even though that's completely at odds with what I think is going on fundamentally.
The significance of 4,000, it was just it's a round number. Really, it was about that descending trend line with the Fibonacci retracement and the moving averages all kind of converging in that 3,950 to 4,000 zone. And so really the way I look at it is that once the market has cleared that zone, it has beat all of those resistance levels and is signifying that their bulls have a little bit more gas in the tank than just a quick little retrace that rolls right over. And so that's the only significance of that. And I like just to reference round numbers that way. But anyway, let's move on to the Euro chart, because we had the ECB do a rate hike and announce the QE for Italy. And yet the Euro never really moved in any meaningful way. It started in the green right off the bat, going toward this 103 level. I was thinking there was room for the euro to even make it back towards 104 as a retracement. But so far, it's been a very muted weak rally. And just like we were talking about the dollar index in the market wrap, there is no evidence that the prevailing downtrend has ended. This is simply a very oversold condition. We printed parity. It got all over the headlines. highs. It was a very oversold number. And we're just seeing a little bit of a relief rally or almost a bounce. But I just don't see anything that is telling me that the prevailing downtrend has changed. And we're going to need more evidence than that. But I would still be watching if the euro starts to roll over as a signal.
Let's move on to gold futures on page 4. Chart does not look healthy at all. We just hit 1680, which, of course, Ole Hansen told us more than a year ago. I think that was a really key level. It held a year ago. You think it's going to hold this time?
Well, yeah, the key thing here is that what I was surprised by was the fact that a lot of cross currencies were bouncing. The US dollar was pulling back, and you couldn't even get a pulse out of gold. It was just showing that at least at this moment, there was no immediate correlation response. We got very oversold, traded right down into the 1680. At least this morning, we've got a reversal candle that we haven't seen a close yet, but maybe it is like a little bullish engulfing candle, but it's a stretch to call this a reversal already. It's still a very distinct downtrend and no meaningful bull breakout. At some point, I actually think gold can very easily bounce back to 1750, but that wouldn't make it an uptrend. That would just be an incredibly oversold market that's bouncing like we're seeing in so many other assets today. So right now, I would respect a downtrend, but a bounce I think is imminent, but that doesn't make me bullish gold yet for the next big uptrend. I think it might take the rest of the summer to really establish the basing formations that gold would need in order to have a fourth quarter rally. And that's going to take, like I said, much of the summer to work out. So I think it's a wait and see in this market. But with that said, Eric, I wanted to move on to crude. Obviously, you have some insights on what's going on. I just wanted to technically observe one thing here and then let you give some insights. The one thing that I was watching for as we approached 100 was that when we inevitably get some sort of news that causes oil to have a quick sell-off, will it show the same characteristics as the S&P 500, which is it starts brushing off bad news and then recovers? So over the next couple of trading sessions, what I'd be really interested to see is whether crude generally holds above 93 to 95 and then starts working its way back to 100. And every time there's bad news, it just brushes it off and doesn't make lower lows. If we start seeing that, that could actually start to signal that the 1 plus month correction in crude oil may have already run its course. But it's still a little early, but that's certainly what's on my mind. What are you thinking?
Patrick, there's a huge amount of merit to what you just said, and I think we're starting to see the signs of it, but not completely. And the Libya news, I think, is a really good indication of that. If we look at that very low point that we had last week, it was the news of Libya lifting force majeure. They had previously announced through a force majeure notice that they were going to stop exports completely due to geopolitical tension in Libya. It was the removal of that force majeure which caused the spike down that ended up going right back up the same day and creating that reversal candle that we see a week ago. Then we had more news out of Libya, similar news. This time it was just, hey, they're on track. They've gotten halfway or more than halfway back to full production. They expect within 10 days to be back at full production. We saw a $5 overnight spike last night, way on down to a 94 handle. I think 94 spot 59 was the low print overnight. We're back up now, as I'm speaking, above $97, and that's about halfway back to where we started before the news came out. Now, some levels to watch there. If we could get above all of the short-term moving averages, that would be the 5-day as the top at 98 spot 33. If we could close above that today, that's more than another dollar, and we've only got about a half an hour left in the session, so I strongly doubt we're going to make that. That would say, okay, the market is completely brushing off bad news and just grinding along, as you alluded. So I don't think we're quite there yet, but we're maybe halfway shrugging off bad news. So I think we're getting closer to that outcome that you're describing.
Eric, what you're saying makes complete sense, but let's move on to page 6 because you asked me to put the term structure up, and I'd love to hear what is on your mind.
Well, we had several listener requests for a refresher on why backwardation is a bullish signal in the crude oil market or commodity markets generally. What we see on page 6, it's not a time series. These are 3 different snapshots of specific dates. So the bottom term structure, the one you see at the bottom of the chart that slopes upward, that is from November of 2020, so about 18 months ago. And what that shows is the usual shape of any commodity. The normal condition for most commodities is the cheapest price is if you want to buy right now. If you want to lock in a price right now today for delivery in the future, normally the market would say, well, okay, look, if you want us to do that, the only fair way to do it is to start with today's price and then consider what's the cost of storage, what's the cost of insurance, what's the cost of, the interest rates and everything. If you want to lock in a price from a year from now, it's going to cost you more because you're getting the benefit of being able to lock that price in at today's prices or a price determined from today's price, and you're not going to take delivery for a year. We got to charge you something for that. That's called contango. That's the normal condition of commodity markets. When you get into a shortage situation, what happens is the sellers of the commodity are scratching their heads saying, we don't know where we're going to get enough of that commodity, enough oil in this case, just to meet the commitments we've already made this month. So we'll give you a discount if you're willing to wait and accept delivery of the oil that you buy today. A year from now, we'll give you a cheaper price. That's called backwardation, and it's an indication that the physical market is tight. It means that there's not enough oil in the storage tanks for the normal contango condition to exist, and the sellers of oil are charging a premium for oil that is sold in the future. Now, if we look at the next term structure, the middle one on the chart here, that's from 1 year ago today. Now, remember what was going on last July. Crude oil prices got all the way up to $75. Oh my gosh, everybody thought, well, that's not sustainable. Surely it's going to sell off back down to 50 or so. I mean, it can't be sustained. The thing is, the physical market was tightening up. People were getting very concerned about Cushing, Oklahoma running out of oil completely. And that's why we got to what was at the time being discussed. I'm talking not about the brightest yellow, but the middle one. The one that is from 2021, July 21st, 1 year ago today. At the time, analysts were saying that backwardation, in other words, the downslope that you see where the front month contract at the left edge, that's the immediate delivery. If you're willing to lock in a price today for later delivery, you get a discount. Well, the discounts were so steep a year ago that most analysts were saying this is crazy steep backwardation. It's not sustainable. There's no way it could possibly last. It has to be an anomaly associated with the ending of the COVID pandemic. It's temporary. We're going to go back down to that normal-looking term structure that you see at the bottom of this chart, the one from November of 2020. Surely we've got to get back to that because it's so steep, this backwardation, it just has to be an anomaly. Well, fast forward to today, that's the brightest yellow, the top term structure on the chart, and you can see whether that was considered at the time to be an anomaly back last year. It's a much bigger anomaly right now. In fact, it is record-setting backwardation. And what we're talking about by when we say backwardation is the vertical space between those dots on the chart. Each dot represents one delivery month. So you go 3 dots down the chart, that's buying oil if I want to lock the price in today for delivery 3 months from today. What it's showing us is there is a very, very steep discount. In fact, it's several dollars per month. Now, to give you historical perspective on this, if we analyze all of the data back to the beginning of the crude oil market, at least as far as the data goes back to the early 1980s, it is unusual for there to be more than 50 cents per month, half a dollar per month of backwardation is unusual. It's normally associated with some kind of tension. There's a war, there's something going on. More than $1 per month is kind of unheard of. It usually means that The Canadian wildfires in, I think it was 2018, led to just a few months at the very front end of the curve blowing out to $2 or $3, but it was only at the very, very front of the curve, and it corrected very quickly as the fires came under control. There have been incidents where there was a spill on the Keystone Pipeline that jeopardized supply of oil into Cushing, and just that front spread would blow out to $2 or $3, and it would stay there for a few days. But it's very, very unusual to get all the way to the expiration of one of these contracts, but it's extremely unusual for one of these contracts to reach expiration. In other words, to get to its last trade date, which we just had yesterday on the August delivery contract. Now, it expires in July because it's for delivery of oil to occur in August. So we call it the August contract, but it's really the one that expires in the end of July. It expired yesterday, and right up until 2 hours before the close, it was trading at $3.80 of backwardation, which I believe to be an all-time record in the history of the oil market. In context. What do I mean by in context? There certainly have been things like the start of the Gulf War in 91 where there were just crazy, crazy blowouts in backwardation at the front of the curve. But as far as the expiring contract on its last trade day having more than $3 of backwardation, absent a catalyzing event, meaning there's no Canadian wildfires, there's no Keystone Pipeline spill, there's no bombings on the Abqaiq facility in Saudi Arabia, which caused a massive blowout in time spreads. There's no event to explain this. It's just because the market is really, really tight. I don't think we have ever in the history of the oil market seen this happen. I don't have intraday data going back more than a few years. If any listeners have that, I would absolutely love to know whether there are prior examples of an expiring contract on its last trade day at noon, that's 2.5 hours before the close, being more than $3 of backwardation premium above the next contract. I don't think it's ever happened before other than at a time when there was a bombing or a war or a Keystone Pipeline spill or something like that. Why do I say at noon? Well, for the last hour or so, the insiders are always gaming this market because the open interest drops to a level where it's very easy for them to do that. So we saw it trading through most of the session yesterday on its final trading day at about $3.80. It did collapse to $2.66 of backwardation. That's still massive backwardation as of the close, and that's due to market manipulation by the insiders. The real number it was trading at is, a couple hours before the close when there's still efficient price discovery in the market. So I'm going to say as of noon, I don't think there's ever been a $3.80 close absent some major war breakout or other event going on. If anybody has that data, please let us know. I'd love to know that answer. So I think it's very significant. What does it say? We've got an incredibly tight physical market. Now, it's tempting to say, well, okay, is that tight physical market just an anomaly because of COVID ending? And, we've got the tension with the Ukraine war, which a lot of people think is ending now. I don't think it's ending, but a lot of people think it's ending. Maybe it's just going to last for the rest of the summer and then it's all going to get better. Well, the way you can tell is to look at this term structure chart, and you do see it's incredibly steep backwardation for about the first 6 months or so. And there's kind of an inflection point in the curve, and it does mellow out a bit, but hang on. Remember that middle term structure, the one from a year ago, that was considered unbelievably steep backwardation at the time. And what we see is the entire curve going out in today's curve, the brightest one at the top of the chart, it goes out for the next couple of years at a much steeper backwardation than we saw at the very front of the curve a year ago, which most people thought was unsustainable. So what the term structure chart is telling us is that the physical market is incredibly tight. It's expected to remain super duper tight, at least for the next 6 to 8 months. Then maybe it gets a little better, but not much better. So this chart is just screaming out that the physical market is incredibly tight and expected to stay tight, and that is massively, massively bullish for oil prices. Well, if it's so bullish, then why the heck, if we go back to page 5, do we see oil selling off ever since that $124 peak back in the middle of June? And on this chart, it shows about $117. The reason is this is the September 22 contract. Back in June, the July contract was the front month, and because that backwardation is so steep, the chart is actually misleading. If we were looking at a continuation chart here, it would show you a $124 top. So it can be very misleading to read the charts if you don't know whether you're looking at a contract chart or a continuation chart. Why have we seen this? Well, as I've been saying for several months, I expected the market to continue to grind higher because of the unprecedented tightness of this market. But then I said at some point, we've got to price in a U.S. recession, which back when I first said that was a very non-consensus view. As it's become a consensus view in the last couple of months, sure enough, we had that mid-June peak at $124. This big sell-off has been the market pricing in the coming recession. Is that over? Did we see that reversal candle back last week after the Libya news and that was it? Or do we still have another wave down, maybe to the contract 200-day moving average, which is not shown here on page 5, but it's down there at 87.69. I think it's entirely possible that if we get more bad news about the recession, we could get a test there. But ultimately, I think we move much, much, much higher. And the reason is we haven't seen a physical market this tight in at least a decade, and I think it's going to get worse because this is being driven by a lack of investment and because the ESG trend has made the sector practically uninvestable by most institutional investors. We've got a real problem here, and it's a supply problem. And yes, there will be demand destruction in the coming recession, lots of demand destruction. That's why we've seen the market sell off so much in the last month or so. I don't think it's going to be enough to overcome the supply issues. I'm working on getting another guest who's done some really excellent writing in this, a guy named Adam Rosenzweig, onto the show in order to talk about this. But until we can get that interview lined up, I'm not sure where it is that the recession gets priced in and we start going up. But I think eventually in coming months and years, we're going much higher in oil prices. It will eventually cripple the economy and lead, I think, to an inflationary deep recession or maybe even an inflationary depression. I think it could get really ugly.
So, Eric, you were talking about the fact that you got that European gas situation wrong last week, and a few listeners called you out on it. Where were you wrong on the call?
Well, Patrick, I didn't actually say I was wrong, but, you're right. I was wrong. What I said last week, and I do stand by my conviction on this part, is I said, look, if Vladimir Putin wanted to squeeze Europe and really make them suffer because of the sanctions that have been levied against his country, he's not going to cut off the gas in July when they don't need it that much. He's going to wait till October when they really need it for heating season. Now, I stand by the seasonality call that that's when Vladimir Putin is going to want to put the squeeze on Europe. What I didn't understand until several of our listeners wrote in, most politely, a couple not so politely, explaining that the way the mechanics of the European gas market work is Europe spends the summer importing Russian gas and storing it in underground storage tanks. And then they spend the entire winter heating season both importing more through the Nord Stream pipeline, but also drawing down from that storage. So the point is, if you want to squeeze Europe in October, the way you do it is you shut off the gas before October, because otherwise it gives Europe time to fill up their tanks, so to speak, and get ready to weather the storm. So I did miss that. I didn't understand that nuance of the mechanics of European natural gas. Remember, I'm an oil trader, not a nat gas trader. So I appreciate the many listeners who wrote in to explain that. I still stick by my story, though, which is if Putin wants to put the squeeze on Europe, he's going to do it in a way that is timed to make it most painful just as we get into heating season. And cutting the gas off earlier, it sounds like, is the way to do that. So therefore, it should come as no surprise that Gazprom this week first declared force majeure, said that they were shutting off the gas. It sounded like, from the way the notice was written, like they were shutting off the gas and not turning it back on, and Europe was going to be completely cut off from Nord Stream pipeline gas out of Russia. They later clarified that it would be restarted this week, but at reduced flow due to mechanical limitations, which Russia says, are a result of Western sanctions. It was restarted today, one day ahead of the original schedule, but at reduced flow. My take, this was a intentional warning shot across Europe's bow. This was Vladimir Putin showing his teeth, making it look like he had cut Europe off completely. That was the doomsday scenario that everybody was concerned could completely crash the European economy. Then after letting them stew on that for a day or two, he said, oh, actually, we'll go ahead and turn it back on, but at reduced capacity. Is the reduced capacity maybe intended to just hold them over because he doesn't want to show all of his cards yet, but to prevent them from building up too much gas in storage? Give them enough gas to use, but not give them enough gas to build up their storage tanks? It makes sense to me. Let's see what the future brings.
Now, Eric, you said that there was an important announcement from Saudi Arabia after the presidential visit. What was that all about?
Well, for context, Saudi Arabia is currently pumping about 10.5 million barrels per day of production. That's already set to increase to 11 million barrels per day when they finally remove all of the curbs that they had put on in reaction to the COVID pandemic. Now, with the removal of those COVID restrictions, they're going to be back to 11 million barrels per day. President Biden tried to get them to increase production or agree to increase production. They said no. But what they did say they would do is that they would, and I think they probably did this because they wanted to give Biden some kind of, something he could announce as if he had made some sort of progress, even though he really made no progress at all. What they said is, well, look, our capacity, the most we could possibly produce if we wanted to, is 12 million barrels. Now, personally, Patrick, I'm skeptical of that $12 million figure, but that's their advertised maximum production capacity. What they announced after President Biden's visit is that they would make their best efforts to increase that maximum capacity to 13 million barrels by 2027. So over a 5-year period, they would increase their maximum production from 12 million to 13 million, but they're not going to do anything more than 12 million now. They're going to wait and use the mechanism of the OPEC Plus structure in order to decide when they would make any increases. So they said no way to an increase that President Biden wanted in terms of doing anything immediately, but they did say they would do their best to increase capacity. They went on to emphasize, and this is the most important point, that 13 million would be the ultimate capacity for Saudi Arabia and that they would never, ever be able to go higher. They later qualified their statement to say to get to 13 million barrels of production capacity by 2027 is going to be really challenging, and they're not even certain that they can promise that. Now, in context, the absolute most that Saudi Arabia could produce now if they wanted to. In other words, if they felt differently about President Biden and they said, we're going to do anything we possibly can to make this guy happy, the most they could do is increase from the 11 million that they're already planning to increase to next month up to 12 million. Well, that's an additional 1 million barrels. That would do nothing more than to make up for the 1 million barrels a day that's currently being drawn from the Strategic Petroleum Reserve, which is completely unsustainable. That's got to stop at some point. They've announced it's supposed to stop this fall. So if it really does stop this fall, if Saudi Arabia did the absolute most that they possibly could, stretched their capacity to the absolute limit, it would be a net nothing, in the sense that all it does is make up for the SPR not being drawn down recklessly any more than it already has been, and when they stop at some point. Now, I don't believe that they could even produce 12 million barrels. I think that at 11 million, they're going to be producing as fast as they possibly can, and I think they're already stretched on their spare capacity, but that's just my personal opinion. Now, what I want you to think about is what if, as part of this ongoing war with the West, what if Vladimir Putin were ever to intentionally pull the gas first and then the oil off the market? In other words, he shuts down the Nord Stream pipeline, says, Europe, no more gas for you. We're sick of your sanctions. We don't want to play your game anymore. And then he says, you know what? We've decided that maybe he says we're going to reserve the oil we produce for export to other BRICS countries within our our BRICS bloc, to strengthen the value of being in the BRICS bloc, we're not going to export to anybody in the West because we're sick of the way that you've treated us with these sanctions. Or even consider this. What if Putin only took half of his exports off the market? Would that cause his revenue to go up or to go down? Of course, if he reduces exports by half, you'd think that the revenue would be cut in half. But wait a minute. If it causes the price to double, which I think it would, he ends up with the same money, and then he can continue producing the rest of the oil and stockpile it in his own strategic petroleum reserve, because I think we're headed into a global energy crisis that will last at least a decade. And I think that this war with Russia will ultimately be a resource war that is entirely about Russia withholding access to crude oil and natural gas as a tool of economic warfare. Now, if he was really intending to do that, I know this sounds like wild-eyed speculation on my part. A lot of people have said on Twitter that I'm crazy and fear-mongering and all this stuff. If he really wanted to do those things, he would be trying to make strategic alliances with other oil producers and get everybody kind of together on his team. You know, think of it as Russia and BRICS trying to acquire OPEC Plus or merge into OPEC Plus and make them all part of his family and under his control. Next headline. Gazprom announced this week a major partnership with Iran to invest as much as $40 billion with a B dollars in building new oil wells to help Iran to restore its full production capacity. So at a time when Russia is supposedly being squeezed for cash, tight on money, they're going to spend $40 billion helping Iran to build a strategic partnership. Why? I think because Putin is playing the long chess game here. He understands that having control over as much of the global energy supply as possible is the clear way to be in the opposite position of what took out the Soviet Union in the 80s. A lot of people think that the way that the Cold War was ultimately resolved was Ronald Reagan doing everything he could to get oil prices down so that Russia would be crippled economically. I think that Putin is playing a long chess game here, which is entirely about trying to be in control of as much of the world's energy supplies as it can so that he can be in the superior position, and it is the West that can be economically crippled because he's holding all of the cards. Certainly, this new announcement about Iran fits perfectly into that. If I'm right, the thing to watch for would be Russia getting friendly with other producers. Venezuela's political situation is more complex than Iran. They're not as obvious or as easy of a country to make an ally of Russia's. But boy, they've got the reserves. They've got a huge proven set of reserves that they don't have the infrastructure to actually produce. They need foreign investment to do it. For Russia to cozy up to Venezuela, just as they are now cozying up to Iran, and try to essentially create a monopoly on many of the biggest producing countries in the world, would be exactly the way that I think Putin is trying to turn the BRICS into the major economic superpower that has control over the rest of the world. And frankly, I think he's playing a very astute chess game, while Western leaders, including President Biden, seem to think they're playing checkers and scratching their heads trying to figure out what the funny-shaped pieces on the board mean. At least that's the way that this appears to me. Now, I don't know if Putin intends to hold the world hostage with energy prices and take over the world, or if he just wants to have a big stick so that he can walk gently with it and show the West that he's got a lot more power than they used to give him credit for. But it seems to me that he has an agenda here. It seems to me that it is a long-term agenda and that it involves controlling energy-producing resources around the globe, not just in Russia.
Well, Eric, after that long monologue, is there anything else left to say about oil?
I'm shocked that you're actually asking me that. I didn't think you would give me the chance. No, I'm done for this week, but, right. This is a rapidly evolving market. Let's move on, though, to your RBOB gasoline chart. What do you think of the technical picture here on page 7?
Well, it's actually a very similar situation. We have a 50% retracement coming back down to the lows of March and April, and it'll be a really interesting level where if it was going to put in short-term lows, this is sort of a level where things can emerge. I don't know if I want to anchor that today's candle is somehow important, but I think that the selling has gotten quite intense here, and I feel that it's much closer than not to a bottom. But I wanted to go and just look at the next two charts very quickly.
Well, before you do that, Patrick, I will add one more comment on crude oil. I just can't resist because the last monologue took so long that even though I said earlier we're speaking to you before the close today, so much time went by. It's time for the close, and we got slammed down in the last few minutes of trading. Just struggling to see. There's about 2 minutes left as I'm speaking, and we're struggling to see if we're going to hold the 8-day moving average, which is the lowest of the 3 short-term moving averages. Looks to me like we're not getting a reversal candle today, and there's probably still lower to go in this market. We'll see what happens. Anyway, let's move on.
All right. Well, I wanted to just quickly point out that so far, the copper chart on page 8 has been a very weak rally, very similar to gold in a sense that there's simply just not a pulse yet here to be found. It's very oversold. Under all normal circumstances, it should have delivered some sort of reactionary bounce that should have got us back to 350, 375, and there just is nothing yet. It'll be interesting. It's still very oversold, still can have a short-term rally, but I still think that the primary downtrend has to be respected. Just there's no sign of any buying whatsoever. And the last thing I wanted to touch on with lumber prices, just after lumber in June retested all of the 2021 lows after being more than down 50% in just the second quarter of the year. And but here we are once again coming back to retest that level. I'm curious whether or not this is where the bottoms in lumber will establish themselves as we test these lows again, or whether or not there's more to come. And that's certainly something that's going to be on my mind.
Patrick, I agree. This is a very important chart to watch because it's so tightly coupled to the home building market. And, it seems like the post-COVID, let's move out of the city if we're wealthy and go build a big fancy house in the countryside someplace. I think that's pretty much played out. Now we've got a really big recession coming, or at least I think a really big recession is coming. You would think that would mean lower lumber prices, but hold on. I think it's going to be an inflationary recession, or a stagflationary recession. Does that mean lumber prices and home building costs go up or go down? Hard to say. I guess time will tell. Listeners, if you enjoy Patrick's chart decks, be sure to check out pages 10 and 11 where you can find out about a free trial of Big Picture Trading, Patrick's trading service, because he does webinars every single day of the week, so you can see a chart deck like this every single day with a free trial. Get that information on page 10 and 11 or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.